In today's video, I'm going to introduce to you 10 chart patterns that you probably haven't heard of, but they can be just as, if not more powerful than some of the more popular trading chart patterns. Most traders are familiar with patterns like head and shoulders, double top, double bottom, ascending triangles, wedges, flags. These are very common chart patterns that are used every single day. Now, these are also patterns that are the go-to for many people learning about technical analysis, but you should know that there are some equally powerful yet lesser known patterns that can significantly enhance your trading strategy if you learn how to spot them. And that's what I'm going to share with you in today's video. Hello everyone, I'm Kathy Lee with BK Traders, and I help traders learn how to make more accurate trades using some of my favorite trading techniques and strategies, along with chart patterns, economics, fundamentals, and combining them to pick the best trades. Before we dive in, do me a favor, please make sure you hit the subscribe button and turn on notifications so you never miss out on powerful trading strategies, big stories, and anything else that I want to share with you. Now, let's jump right into it. The first pattern that I want to talk about is called island reversals. The island reversal pattern is a powerful chart formation that signals a potential market turn. It is identified by its dramatic structure. This pattern combines gaps with price action to signal a potential shift in market sentiment. With island reversals, what you're looking for is a sequence that starts with price gap, followed by sideways movement, and then another price gap in the opposite direction. A bullish island reversal typically appears at the end of a downtrend, and that's basically what you want to look for, and signals a potential bottom and move to the upside. A bearish island reversal, on the other hand, occurs after a uptrend and signals a potential top and move to the downside. When this chart pattern is combined with high volume, and not all instruments provide volume, it can be particularly powerful. We don't have that many gaps in the forex market, so you don't see island reversals as often, but you can find them very often in indices and individual stocks. Here's an example in the Dow Jones Industrial Average. In this chart, you first see a gap down that is later followed by a gap up, which signals a new uptrend. We also see a complete shift in sentiment, which makes this potential trend reversal so powerful. Now, pattern number 2, the 3 black crows. In this pattern, you'll find 3 consecutive bearish red candles, each one closing lower than the last, and that's really important. When you see this pattern, especially after a strong uptrend, it can be a sign of a reversal because it suggests that buyers are exhausted and sellers have taken control. We see this very often in currencies. You can see an example of this in the Eurodollar chart. After hitting new highs, Eurodollar formed 3 consecutive red candles. Our third pattern is the 3 white soldiers. 3 white soldiers is the opposite pattern of 3 black crows. This reversal pattern consists of 3 positive green strong bullish candles. When you see this formation, it is a clear sign that buyers have taken control and that the trend is shifting from negative to positive. The steady rise without large shadows on the candles indicates that buying pressure is strong and the market may continue to move higher. And you can see an example of this in this chart of how the 3 white soldiers pattern works in currencies. In this dollar-yen chart, we have a long downtrend and a bottom that is marked by perfect 3 white soldiers pattern with 3 consecutive strong positive green candles, each closing higher than the next. The fourth pattern that I want to talk about is called the Tweezer top. The Tweezer top is a bearish reversal pattern that happens at the peak of an uptrend, and it features 2 candles with the same high price. You don't always get exactly the same, but you do see it quite often in currencies. And this signals that the uptrend is losing strength and the market might reverse lower. This pattern is often signaled by increased volatility as it reflects a struggle between buyers and sellers at a key resistance or support level. Take a look at this dollar CAD chart. While the highs aren't exactly lined up, they're pretty much in the zone within 4 pips, which is close enough. What's interesting here is that dollar CAD had a very nice run, a strong uptrend that lasted from July all the way to September. It had 2 daily candles with virtually the same high price, but the move failed to extend, and instead, dollar CAD peaked, tumbling nearly 200 pips in about 2 weeks, and we see this pattern a lot in currencies. Our fifth pattern is the Bullish Harami. A Harami is a 2-candle reversal pattern. A Bullish Harami has a small bullish candle that is engulfed by the previous bearish candle, signaling a potential reversal to the upside. A Harami suggests indecision and a possible shift in market sentiment, often signaling a change in trend direction. Here's an example of a bullish Harami in Euro Kiwi. We can see a large red candle followed by a smaller green candle. The green candle body and wicks are completely inside the red candle, signaling a potential turn for the currency pair. The sixth chart pattern is the Bearish Harami. A Bearish Harami is the opposite of a Bullish Harami and is a warning of a downtrend reversal after an uptrend. It is a two-candle pattern with a larger green candle, followed by a smaller red candle that is completely within the previous candle. This Euro-Swiss chart shows a classic example of a Bearish Harami. In this chart, you can see that a Bearish Harami formation marked the ultimate top for Euro-Swiss, timing a perfect reversal on the daily chart. Our seventh pattern is the three inside up chart pattern. This is a three-candle bullish reversal pattern that signals a major turn in the market. After a strong downtrend, what you want to look for is a strong bearish candle, or big red candle, followed by a small bullish green candle, and then a third bullish green candle where the high is above the high of the first bearish candle. And this is a very important part. This is what we look for to confirm that the reversal and the shift in market sentiment from bearish to bullish is real. Here's an example in the NASDAQ. First, you have a big red candle that makes a new low, followed by a smaller inside Harami-like candle, followed by a green candle with a high that exceeds the high of the first candle in this three-candle formation. The eighth pattern is the three inside down chart pattern, which is the opposite of the three inside up chart pattern. In this pattern, you're looking for a big green candle, followed by a smaller candle, which can be red or green, ideally red, of course, and then a third candle that closes below the open of the first candle. You can see an example of this in the Kiwi dollar chart shown here. We have a big green candle, which marks a new 2-month high, followed by a smaller red candle, and then a larger red candle that closes below the open of the first candle. Now you can see here that it doesn't immediately break down. It consolidates for a few days, which still represents indecision. And the right stop here would be at the first green candle high, which is the swing high of the period. With that stop, the trade took a while to move, but it did correctly signal the top of this trend and the beginning of a nearly 300-point drop in Kiwi dollar. Our ninth pattern is the falling three methods pattern. While it is called the falling three methods, it is actually more than three candles, which can be slightly misleading. In this bearish continuation pattern, what you're looking for is a strong downtrend that is briefly interrupted by a few small candles. Ideally, they could be bullish, but a small red candle in between is fine as well, before the market continues its move lower. It's a sign that sellers are still in control and the downtrend will likely resume. The pattern shows that any attempts by buyers to push the price higher are weak and temporary and not lasting. What I'd like to see is that the low during this consolidation period is actually broken, which would be a strong signal of trend continuation. And we can kind of see that here in dollar yen, where we have a strong downtrend from a high near 162, followed by 3 days of consolidation, followed by a bigger red candle that closes near the low. Now, there are two places you can enter here, either right at the close of the low or the break of the bottom of the green candle with that tiny body and the long wick. We see this chart pattern very often in currencies, although it's a little sloppy and not perfect. The final pattern that I'd like to share today is the piercing line pattern, which can be bullish or bearish reversal pattern, and typically occurs at the end of a trend. It is a two-candle pattern. For a bearish piercing line pattern, you want to see a strong bullish green candle, followed by a bearish candle that opens higher, but ends up reversing and closing lower than the midpoint of the previous candle. This pattern signals that the bulls are losing control and the bears are starting to step in, which could lead to a bigger move lower. It's particularly powerful when it's found at a key support level or just a key technical level. We can see an example of that here in the NASDAQ. While it's not the beginning of a strong downtrend, the pattern still signaled a 300-point drop in the NASDAQ. And we see this pattern quite often in currencies as well, although, it might be slightly different. These patterns are extremely valuable, but like any tool, they work best when combined with other analysis methods. Here at BK Traders, we always use a combination of fundamentals and technicals to help us select the best trades. And incorporating some of these lesser known patterns, learning how to identify them can help you become more precise in your trade selection. And when they coincide with a strong technical or fundamental setup, or for me, when they coincide with my zip setup, they can significantly boost my trade accuracy and yours as well. And being a consistently profitable trader is really about finding the highest probability trades. If you're interested in getting my trading strategies and indicators, check out the special offers in the description below, along with some of the discounts with some of the prop trading partners that we have. This is Kathy Lean with BK Traders. Thanks for watching. And if you found this video helpful, don't forget to subscribe and leave a comment below. I would love to hear which chart pattern you're excited to try in your next trading.